Joining Vox Markets today, we have Cadence Minerals CEO, Kiran Morzaria, who will be taking us firstly through his investor presentation, and this will shortly be followed by a Q&A. So without further ado, take it away, Kiran.
Thank you, Francesca. Thank you for the introduction. And I'd also like to thank all the shareholders who have submitted numerous questions. I think we had somewhere in the region of over 50 questions. So what we're going to try and do now is I'll try and incorporate some of those answers into the investor presentation, and then obviously we'll do the Q&A afterwards. And some of these, this is a full presentation, so some of these slides we will go through relatively quickly because I think most shareholders have seen them, but the full presentation will be available on our website in addition to this podcast. So this is the standard disclaimer. Read it, it's important. So I'll let you do that at your own leisure. I think we've all seen the investment strategy of Cadence. In pretty simple terms, it's to identify high quality assets, invest them via debt and equity, assist in management, taking up the value chain, monitor, and then importantly, we either retain or reinvest it in new assets as we move forward, such as we've done with the Amapa asset, which we've crystallized some value of late with the signing with the settlement, the bank settlement. I think you've all seen this map, which is a summary of our principal investments. I think what has changed here is that the direct project investments, which are in grey, are becoming far more dominant in our portfolio. That's because we believe we can extract more value from that by being actively involved in the management of those assets. Our primary equity holding is European Metals at 9.3%. And of course, we do have a smaller trading portfolio, which has a value at this point in time of about £500,000 to £600,000. And those are various lithium assets in Australia. The next slide, well, I think this is what has probably been the largest driver of value in Cadence over the last 2 years, is the Amapa iron ore mine. As we've seen beforehand, it's a de-risked asset, low capex and a quick cash flow. We all know about this asset. We know that we can earn into 27% for $6 million. We have a first right of refusal to take it to 49%. And previously, we know that this asset was worth, as a correction, that it should be 660 million as written down value by Anglo American. What is great about this asset is, as we've talked about it, it's got relatively low risk in terms of licensing, in terms of capex, in infrastructure, mineral resources known. So it's easier to develop as an asset. It does have its unique issues and problems because as you're going through your PFS, you will find issues that weren't discovered beforehand. But as far as we're concerned, it's a very low risk asset to get involved in and deliver value to our shareholders by investing in this asset and taking it towards production. I think this asset slide slightly changed, but it shows us about the Amapa iron ore and the project statistics that we have there and the process. We know that it's got a 14-year mine life. It's got 180. We redid the resources and had 187 million tons worth of iron ore at around 39%. Gives us a 14-year mine life. There are, as shareholders have pointed out, there's about 800 million tons of potential resource. I had that sort of definitive MRE or mineral resource estimate in this compact itabarite, which is below the current areas of mining. So that would be something that we would investigate going forward to increase the mine life. But it's really not part of our plan at the moment because if we go down that route, we're talking about different expansion, we would require different licenses, different operational licenses. And to ensure that we get to production quicker, we want to ensure that we have the same operational licenses and the same process flow so that we don't have questions from environmental authorities and having to resubmit things like EIAs, environmental impact assessment. At full capacity, we're looking to do 5.3 million tonne per annum of iron ore, of which the large majority, 4.4 million tonnes, would be 65% iron. The life of mine OPEX to free on board, pardon me, is estimated to be $21, and the capex rehabilitation required is estimated to be $168.8 million. Now, I have a caveat at the bottom there. We have to remember that these figures were done in 2019, were redone in 2019, adjusted for inflation and, of course, real exchange rates. But they were done on 2015 site inspections. So these figures will be updated as part of the PFS. And I certainly would expect things like CapEx to increase. And I think I've previously said it would, very early estimates, not based on PFS, that could be closer to 200 million CapEx. And I think you can see there is the process. We've got the geology, mining, processing is both dry and wet, railway transportation, ship loading, which is all our integrated process. And then I think there's another question people were asking about, longer term shipping. Of course, at the moment, because we don't have an operating port, we've been using Handymax vessels, which is not a long-term solution to our shipping. It would be done through Handymax, which is effectively take a Handymax from our port, take it outside of the Amazon Delta, and then do a transshipper. Now, whether that is in Trinidad and Tobago or further south really depends on what economics and what deal that we can get, and basically it's basically down to economics. On a practical sense, you'd rather the transshipper be further south because the route that the shipping goes, the Capesize vessels would be transferred onto Capesize vessels, would be via the Cape of Good Hope to China. That is the quickest route to go through. So the idea would be to do a Handymax, a transfer, a transshipper to Capesize vessels in the longer term. But that would not be the case probably wouldn't be our case for our stockpiles at port at the moment. I think another question that was asked was, well, what's the exploration and expansion potential? Now, this is from Anglo American, their own internal documents. Look, I've already talked about 187 million tons, which are the assets under Amapa control, and a further 800 million tons of resource potential, semi-compact and compact tabarite. These are under our control, under our licenses. We have a broader resources potential where we look at beetle resources, which is a gold asset, it's now called Great Panther Mining, adjacent to us. Previously, Anglo had a deal, and Zamin, the previous operator, had a deal where there was a deal in relation to mine iron ore from their areas. That has to be re-established, and that would provide additional mine life for us. And there's also broader resource potential, which I think Anglo stipulated very, I would say, slightly speculatively in the order of 1.2 to 1 billion tons of additional potential resource in the region generally. I think our targets are, of course, our initial 187 million tons. Let's get that extracted and moving. And in the short, and also post PFS, probably look to add the adjacent beetle resources into our resource model to expand the mine life. So where are we now and what's happening? I think that's something people to understand. Now, obviously, we all know that the settlement agreement has been reached with the banks. That was done at the end of last year. And we're now, there's some process to follow from that, which we'll talk about a bit later on in this presentation. But you can see here where we are with the pre-feasibility studies. We've completed the mineral resource, mine planning, the consultant's been identified and is being engaged, process engineering, scope and consultants being identified and being engaged. Logistics rail, the rails, so the rail study has been completed. It's in draft form. We're currently reviewing it. We feel that there's probably some cost optimizations that can be done there. And the port logistics is probably the one that's a bit more lagged, and that is primarily because we're trying to get the original drawings and data gathering rather than having to do an engineering study again. That is really important because of course, that is the port had a failure, and so we had to ensure that get all those geotechnical studies, all the retaining wall studies, because about 3/4 of the retaining wall is done for that. So there's a bit more work there, and the logistics and shipping and finding the optimal process, transshipping where and how the consultants being identified, and that's ongoing. So we're progressing well with the pre-feasibility studies and certainly on time as far as I'm concerned. So what are the other operations? Obviously, we all know that we shipped stockpiles made in the first half of 2021. Ultimately, and that netted us near, well, about, I think it was about over $8 million in revenue, well, profit actually. And we have the ongoing maintenance of the processing plants, pits, and early infrastructure. That means we are scanning the plant, which is through X-ray scanning. We are now going to be cleaning up the plant, and whether that be sandblasting the plant. The pits, we're making those pit walls stable, and the early infrastructure you've seen that we've been doing in relation to accommodation and offices, etc. Importantly, and which is one of the things that we have been liaising with federal and state authorities, you've seen a couple of licenses that have already been granted. We have the railway concession granted and the federal port license reinstituted so far. We're now working on several other licenses, particularly A&M, which is the mining licenses, that needs to be brought back into compliance. And that's ongoing, and that's regarding filing and the mine plan and the geology, effectively the updated resources, etc. That all needs to be done and filed. And then there's a state level there, these things called Guia de Operação, which is the operation license, which effectively the environmental licenses, which also there's a process to go through and to get those done. Tailing storage facilities, as is studies, which is the studies of where it is at the moment, is ongoing. That's due to completion in Q1 of this year, will be submitted Q1 this year. That means that we'll be in compliance with our reporting requirements in Brazil. We then will need to get the license to operate that, and that licensing process will start in the second half of this year. So that's where we start in the operations. I've also put an estimated timeline. It's important to understand that these are estimated timelines. The critical path here, I believe, will be effectively the environmental granting of the environmental licenses, the project financing. Of course, without it, you can't build the asset. And the shipping is really dependent on the margins. And at this point in time, the margins are relatively small, even though shipping prices come down and iron ore has stayed for our product at $80 a ton. There's still the margins a bit too small when you have to take account of moisture content. So we're not shipping at this point in time. But you can see that we expect that our 3.5 million we'll have to take our next tranche of 3.5 million in that period of H1 and H2 this year. Pre-feasibility studies will be ongoing all the way, pre-feasibility and feasibility studies. Feasibility studies are required for the project finance will be ongoing through this year and some of the next year. And then we will have our estimated right of refusal. I think would be called in the second half of or third quarter or fourth quarter of H2 this year of this year. And all while this is ongoing, we're doing maintenance, repair, and recommissioning. We're not putting a timeline at this point in time of the exact point at which we would be back in production, because I think those are all determined by the results of the studies of pre-feasibility and feasibility studies. But I would certainly look to be in production in 2024. So this process, the next slide is our investment. We've talked about when that's going to occur, or where we envisage that to occur. So where are we with that? And I think it's obviously this asset has gone through a complex judicial recovery, and we've got the settlement agreement with the secured lenders. The transfer of 100% of DEV to the JV Co we anticipate occurring in February 2022. That's because actually the courts don't actually open, or the parts of the commercial courts of São Paulo don't actually open until the 20th of January. So we expect that to now occur. We expect that to occur in February 2022, at which point we will own our 20% and progress from there. The 3.5 million, I would say that the key licenses have been granted. So we have a right, we're obliged to invest our 3.5 million to take us up to 27% once the above conditions have been met, i.e. once we've got our 20%. And the first right of refusal, I've already gone through on in that regard. So I think that's in essence all in relation to Amapa. Everything that we've covered off there, I hopefully answer some of those questions as well. European Metals Holdings, I don't think I need to say much more about that. They're going through bankable feasibility studies. You know, we have just over 9% in that asset, and it's progressing really well. We will see how they progress in terms of their bankable feasibility study as they move forward. The next slide is the Sonora lithium project. Now, this is there's been many questions about this. I think we all know about the value. We know about the asset. You know, it's the largest, a very large lithium deposit of 8 million tons of LCE, open pit mining with 250 years resource life. I would, you know, now that Gafeng have nearly completed the acquisition, it's great to have a partner like Gafeng involved in the development of this asset. Certainly, it adds value with their experience. They're an integrated, it's the third largest lithium compound producer in the world with a vertical integration. So having someone like that involved is really important. I think it's also important to highlight where our JV areas are. You know, our JV areas are on Fleur and El Suez. Now, although they represent a fairly large part of the resource, you know, there's about 4.9 million tons of LCE within our resource. In the mine production, it only really is coming from year 8 to 19 and mines a total of lithium carbonate of 72,000 kilotons of LCE from in that time period. Now that can accelerate. And the reason for that is not because there was a conscious choice by Ventana by Bacanora not to mine area. It's simply because of economics. Because as soon as you get to the Fleur area, there is a down fault and it increases the overburden by moving the deposit lower. You have a much larger overburden. And so even though it's effectively the same deposit, because of the fault line, which just occurs on the southern side of our boundary, or the northern side of our boundary with La Ventana, it means that there's an overburden and therefore it gets mined later on in the life because it's less economic. So the only way that changes is if the mine plan changes significantly and that we start to mine much earlier. At this point in time, like they go straight to 35,000 tons. At this point in time, they're going to 17,500 tons. And the mine plan stipulates that they go to 35,000 tons in after year 4. Yangibana project, again, people have showed a great deal of interest. Understandably, they're working really well. They're progressing really well. We have a free carry up to 30% up to the start of the bankable feasibility study. No bankable feasibility study has been done on our area, but within our understanding of the mine plan, and you can see that our proportion of reserves and resources, it's smaller as a proportion of it's a smaller proportion than of the total. But you can see that the ore mined from our areas is about 1.7 million tons of ore from years 12 to 15. Synergy. Well, I think this is a highly prospective area. It's interesting. We're a joint venture partner in this with Lithium Technologies and Lithium Supplies. We see it as highly prospective. We're looking at the surfacing sampling that has been completed, and the assays have all been delivered, and we're analysing this. And we'll report on those once we get an interpretation, see if there's a drill target to be identified, particularly in our priority targets, which are adjacent to core lithium. You know, you would have seen that the CZZ, we agreed mutually that CZZ option to be terminated. That's primarily because not all of the lithium technology and lithium supply shareholders agreed with those terms and had agreed with those terms. And in a way, that's quite useful for us because I certainly believe we'd be able to extract more value, either through advancing the project ourselves, or in fact, there are probably other suitors out there that we could extract more value on this asset. So keep your eyes peeled on how we develop this asset as well. So I think on that basis, I've hopefully covered a large chunk, gone through that quickly, but we want to get to the Q&A session. And so thank you very much, and let's move on to the Q&A session.
Well, thanks so much, Kiran, for that presentation. Now, as you pointed out at the start, we've had a lot of questions from the investor community, and so we'll try and cover as many as we can. So to kick off, in regard to the economics of the Amapa project, we have an investor asking if you have any forecasts for turnover and profitability once the mine is in full production, and how will this commissioning, how will the commissioning stages be financed exactly?
Yeah, thank you for that question. So yes, we have our own internal turnover and profitability forecast, which we derive our NPV in project and made our assessment on our investment based on that. However, this needs to be externally vetted as part of the pre-feasibility study. So these figures and the NPV will be available as part of the PFS. In terms of the question about financing, depending on different commodities and risk profiles, mining projects are financed by a mixture of project debt and project equity. Typically 60 to 70% of it being debt and the rest being equity. Our investment structure, by our first right of refusal, allows us to increase our stake to 49%, which I estimate, and I have hastened down that I estimate, would be between the $20 and $30 million to take us to that point. And that will, of course, change. That could change depending on negotiation. We can choose to participate or not, and that decision will primarily be based on the opportunity cost of capital and the expected return on our investments. If we choose not to invest, then of course we retain our 27%. However, if more equity is needed, we could be diluted further. If there's more equity needed in the project, we could be diluted further unless we participate. So I hope that's answered that question. Of course, I can't be clear about the turnover and profitability because that really, as I said, needs to be vetted by external process and will be part of the PFS results.
That's great. Now we have a couple of questions on the corporate side. One investor asks if you'll be taking on any board positions.
Yeah, I'll be taking a board position on the joint venture company of Amapa, and I will do that in February.
And can you touch on any information regarding Indocino, the majority partner?
Yeah, so Indocino was a creditor of the Amapa project. They're a small commodity trading house in Singapore. That credit has gone into our JV, so that's what they've added into the JV as a creditor of around $50 million. And they have been really key for us to obtaining historic data and identifying key personnel for the asset, which is progressing the pre-feasibility study and the management of the asset at this point in time.
That's great. Now, one investor asks that if the economics were favorable, would Cadence consider investing or partnering in commodities such as green steel or a pig iron facility?
Yeah, if they are favorable, of course we would be interested in doing so. But let's get the PFS complete. Let's realize that what we have to do here, and one of the great thing about this asset and short circuit this asset, is that if we stay within the parameters at this point in time of the production profile, the resource, the mine, the port, as we're originally operating, bar the change in product mix, we're going to a 65% product mix more than the mixture that was beforehand of 58, 52, 62 and 65. That is where our operational licenses are based on. So if we reinvent the wheel here, we'll have to go for a full set of operational licenses and environmental assessments, and that can take multiple years. We're talking 2 or 3 years to get that done, especially environmental impact assessments. So by staying within the margins that is the operation as we've outlined, we don't have to go through full environmental approval. So I've slightly gone off track here, but what I'm trying to say is that we would be interested. It's something for the future. It's certainly not going to be part of our plan over the next 2 years. And of course, any such partnership would require financing, and we have to focus on getting financing for this project, getting this project producing.
Great. Now, just talking about financing, how advanced would you say project financing is in terms of the discussions around Amapa?
We've been approached by several possible strategic investors, financiers, off-takers. However, these talks are really early stage, and we'll ultimately need to complete the PFS and then the feasibility study to finalize any project financing.
And how much of the total sum of the Amapa creditors is due to secured creditors?
Yes, and I think people noticed that I didn't put how much we'd actually settled the secured creditors for and put an overall sum. So overall, we settled in 45 cents in the dollar or thereabouts, which I think is a great achievement, because if we take the secured creditors alone in the original plan, they were going to be repaid their 135 million in its entirety. We've reduced that substantially. Now, I would love to disclose that amount. However, you can understand from the secured creditors' point of view, and of course in our agreement with them, they don't want this amount disclosed, as it could compromise their settlement negotiations that they are doing. Please, got to remember that our amount of 135 million is a simple drop in the ocean compared to their non-performing loan books of billions of US dollars. So we're not going to be able to disclose that just because it would compromise their commercial negotiations with any other settlements that are undergoing on far larger sums.
Now, touching on the joint venture, one investor asks if you could explain the JRP and the agreement with the banks in a little more detail.
I think this sort of goes through what I've disclosed just beforehand, and for the sake of expediency, I would refer the shareholder to the multiple announcements we've made on the JRP, all the way back to whatever it be, August in 2019. And in terms of the settlement agreement, what we're able to disclose is in the announcement that we have announced just recently.
And in terms of licensing, how is this progressing, and what is needed exactly to take the holding to 27%?
Okay, yeah. So as you probably understand, there are multiple licenses to get an operation of this complexity back into full operation, both at the federal and the state level. We've had the railway concession and the Federal Port Authority reinstated or reconfirmed. These are critical in my view, and that brings us to the point at which we are able to go to our 27%. The main other licenses which we need to look at, which I discussed beforehand, is the tailing storage facility license and compliance, which is ongoing, outlined in operations beforehand. We also, at a state level, need to renew several environmental operating licenses. And as I said beforehand, if they were new licenses, we would be required to carry out a full environmental impact assessment, which is requiring a full year of environmental data, a full report and processing. That process can take 3 years. However, given that we're not changing the mining, processing, logistics, our belief is that the EIA that we have should suffice with some updates. So that allows us to short circuit the development program. And we are in the process of preparing this to be submitted to the state, or SEMA, the state environmental authorities.
Now, just touching on the port, can you tell us exactly how refurbishments are progressing at this stage?
Yeah, absolutely. So to commission the port to its full operational status, and we know we talked about the jack-up rig beforehand. It's not simply a matter of floating the jack-up rig. There are many other components, whether it be testings testing the retaining wall integrities, geotechnical investigations in relation to load-bearing capabilities in relation to how much we're able to store there, recommissioning of all the infrastructure, whether it be the stacker retainer, the conveyors, and as we've just talked about, the operational licenses. All of those need to occur before that port is recommissioned to its full capacity. Therefore, I expect it to come online around the same time as other parts of the operation, so the rail, mine and beneficiation plant. So for clarity, our stockpiles, or the retaining stockpiles that are there, will be in all probability shipped from the current state port and not from our port. Our port will be utilized to ship new material.
Now, one investor has pointed out that certain studies have indicated the possibility of the port receiving new ships with new capacity. What would the implications of this be, and how would it affect the economics of the project?
I haven't reviewed the detailed study, but I would say the biggest constraining factor, whether you can load Panamax there, is not the length of the public port, and in fact, not the draft at the public port and our port, because the draft, or the depth there, is about 20 to 30 meters. It's in fact the draft at the Amazon River mouth, which is about 11.5 meters, which therefore limits Panamax and Capesize vessels' entries and egress into the Amapa port. the only way you could do it is partly load a Cape-sized vessel or a Panamax vessel and then fully load it elsewhere. So the shareholders should expect, as a default position, us to always be loading Handymax there, and as mentioned before, taking that outside of the river mouth and taking it to a transshipper, whether that be Trinidad Tobago or somewhere further south in Brazil, if at all possible. So Panamax and Cape sizes, they're not going to be ever fully loaded at those areas because there's only an 11.5 meter draft at the Amazon mouth.
Understand. And in terms of production, what is the schedule for shipping the current reserves of ore, just to highlight that?
Yeah, I think I've just answered based on that. That's always going to be done on a economic basis. So at this point in time, even though we have, the Handymax vessels have dropped from $80 to $90 per wet ton to around $60 to $70 per wet ton, and our products 58% Fe at 80%, $80 per dry ton. When you take into account there is a margin when you talk about the moisture content, taxes, we're not shipping at this point because the margin is not enough, and there's possibly a risk that you could end up losing money on shipping. So you still have to wait for that shipping to drop further.
That's great. Now, of course, there's an increasing global investment interest towards carbon neutral steel. Is this something that Cadence has considered in terms of looking forward in their partnerships?
Yeah, so this is COP26. They're looking to carbon neutral. I would say, and that is there's several ways to do that. Is increase the quality and product of the steel to 67, 68%. And of course, how do you process the steel? Well, one part that's really important is that this plant, for the large majority of it, or in fact all of it, will be powered hydroelectric, so it'll be powered by renewable methodologies. We will be producing majority as 65% products, so it requires a far less energy to convert it to steel. So our carbon footprint will be lower than a typical Australian producer, but it's not. At this point, we don't envisage going to 67, 68% because that would require further, effectively, plant design and plant engineering. And as I said beforehand, doing that would only, I think, delay production further. It's something we should look forward in the future, but that's after we've got this thing into production with the parameters we stated beforehand.
Great. Now, in addition to what is already reported, one investor asked if there are any more stockpiles at the mine or the rail terminal that could be sold to help funding.
There are no further material stockpiles or processed ore that belong to DEV at other locations apart from what we've disclosed.
That's great. Now, the FT reported that Anglo acquired its 70% stake in Amapa for 1.9 billion. Now, do you believe it's possible for this valuation to be achieved in the future? Someone else.
Yeah, we're aware of this traction, and I would love to be valued at this level. I would add that the valuation for this was at a fully licensed producing asset with a longer mine life. Ultimately, the NPV valuation will be dependent on the profitability of the mine, and that includes our costs and, of course, our long-term view on the value of iron ore. We believe we'll get a relatively low cost of product, low cost FOB delivered to the port, and in the longer term, we hope to increase the life of mine through further exploration on the Amapa licenses and beyond. However, as I've mentioned, our focus right now must be to get these studies done on the current resources and get the mine into production, as we highlighted beforehand.
What is the likelihood or cost for Cadence to take that ownership of Amapa to 49% interest?
This refers to our first right of refusal. As a first right of refusal, we will always be offered it. The mine is going to certainly need more money, so I expect us to be offered it. I mentioned beforehand in a previous answer what I thought those costs would be, and they're estimates at this point in time.
Great. Now, one investor asks if there are any plans for your JV at Sonora.
Well, at the moment, obviously, Gafeng is taking over, or has taken over Kiran Minerals and is now the 100% owner of that asset. At the moment, the JV stipulates the mine plan as per the feasibility study, and there's been no material change to that. So unless otherwise I've been informed, we're sticking that those are the current plans for JV at Sonora.
Now, in terms of valuation, one investor asked if you ever see the share price getting back to a level that would enable a profit for the company.
I think this, would be enable a profit for that shareholder. He's seen the price reduced over 10 years quite significantly. Look, I provided some analysis on this previously, where I showed at the end of 2015, the market had added a substantial premium to the book value, and that's being our value in what we had at the time, which we had our JV in Sonora, 10% of Bacanora Minerals and Yangibana. I believe, the book value was 20% of the market capitalization at the time. And then subsequently to that point, the assets, as the assets developed, and as we've seen, it's clear that our areas were going to be mined much later. And so that premium started to narrow, so much so that by the beginning of 2017, our market cap reduced to approximately our book value. And it stayed at that way until March 2020. And at that point, the market started to recognize Amapa. And I believe that investing the majority of our time in the right assets, right people, and the right agreements, so private projects majoritively, in which we have the right agreements with negative control and can be heavily involved in development, like Amapa and Synergy, we can drive these assets up the value curve, which should reflect in our share price. So this has worked to date and has taken the market cap of the company from 3 million to 45 million. I can only continue to try and deliver value in that regard. Let's see where the price ends up as a result of that.
Great. Now, one investor references Hastings and their plans for a new mine. Can you update the community on how this is progressing and if this is correct at all following their new statement from July?
Yes, and I think this is the statement where they showed a lovely graph which showed Yangibana Northwest being mined from year 1 to 12. I think if you review the news release in further details, you see that Yangibana North has both concessions, but 100% owned by Hastings Technology Metals and 70% owned by us. The majority of the mine plan is on their area. And that because they've got a higher basket of rare earth elements, higher value basket of rare earth elements, they've got high concentrations of neodymium, which is used in permanent magnets. So if you look at my presentation, at the moment in the mine schedule, our areas will be mined from 12 to 15. Just read the release properly, and our information is that it will be mined from years 12 to 15.
Now, one investor asks, did the company need to provide approval for its change in ownership of the Mexilit and Megalit joint ventures?
Yeah, so this is in relation to Sonora. No, we did not, because Gafeng were buying the parent company, Bacanora Minerals. The tag-along rights, which I think this investor is trying to get to, only applies if Bacanora sold its stake directly in Mexilit and or Megalit. So as it was the parent company, they take ownership of all the subsidiaries. We don't have a say whether Gafeng can take ownership of the subsidiaries. They own the parent, they own the subsidiaries.
Mm. And do you see this impacting the value of your shares in any way?
Gafeng's ownership. Look, having Gafeng, ownership of Bacanora and the wholly owned, having Gafeng, one of the world's largest lithium compound producer, as the owner of Sonora, is really positive for the project. We believe it de-risks it substantially. One of the primary risks associated with the Bacanora deposit was really the financing. It's a substantial capital investment. I think stage 1's 400 million, stage 2's another 500 million. So it's great to have them because they certainly have the capital to do so. And in addition to that, access to the capital. And in addition to that, they stated in their interims that this is going to be a focus for them. Now, as to the impact of the value of our asset, this is very much depends on Gafeng's production profile. But do they increase that production profile and bring our production forward from year 9? So, of course, the earlier our production comes in, the higher the NPV, and therefore we would expect a higher value in our share. But I think the involvement, and as we get closer to production And if there's a change, we'll change our value of our Cadence's JV, and implicitly by increasing the NPV, increases the value of our JV share.
Mm. And do you think Gafeng would consider purchasing Cadence or your joint venture shares? And what would the reception be if there were to be an offer?
I think in relation to purchasing Cadence, I think we're talking about the JV here rather than anything else. Look, we would be receptive to a sensible offer.
Now, one investor points out the royalty claim of 3% that was contested on some of the mining concessions. And they asked, does this royalty claim exist on all of the Sonora mining concessions or just the ones that were contested in court?
Our understanding, it's just there's no royalty over our JV areas.
And one investor asks regarding the dependency of Gafeng, is this necessary or is there any way to exploit the resource without them?
Look, as a junior partner, we're 30%. Any development requires a proportional voting right. So if they would allow us to develop it, yes, we could, because they would vote in favour. But I don't see there's any practical reason to do so, because ultimately the processing technology and all of that lies with Gafeng and the development of their plant. We would rather, then develop it, then take it forward, and mine from our areas when needed.
Now, the current plan states that your portion of Mexilit will be mined in years 9 to 19. Are they contractually obliged to stick to this? What can you say about this timeline?
So in relation to the timeline, I think there's other aspects where people view, they've publicly stated that they're reviewing lithium plant production to rate above previously 17,500 years per tonne. Look, at this point in time, the bankable visibility study is the document that we need to utilise, where they start at 17,500 in year 1, and then they increase to 35,000 tonnes per annum of lithium carbonate at years 4 to 5. They haven't communicated to us, and there is no definitive technical document that shows them increasing tonnage. So obviously intent, and we'll see how they develop that. I know that in their interims they said they were going to use, they were going to produce 20,000 tonnes of lithium hydroxide. Look, once we have a definitive understanding of economics and the mine plan and how that's going to affect, we can report on it. At this point in time, we have to use a feasibility from 2019. Now, that feasibility study is just a plan. It's not a contractual commitment. So, that's the plan for them to mine to it. There is no contractual commitment on anyone to mine it, in that period. It can be mined earlier, it can be mined later, depending on the production profile and the economics.
Now, are funds needed to be able to develop the joint venture?
To develop the JV, the way that we anticipate it working is, at this point, no, there's been no cash call on it. So we haven't been cash called on it, and any money that would be required will be, I expect around the time that we start to be mining Mexilit in year 9. And in addition to that, I suspect that we'll be mining it on a toll treating basis rather than having to invest substantial capex.
And if mining begins, what sort of financial obligations will Cadence have? So,
there are no obligations under this joint venture with Sonora. They can do a cash call. As I've mentioned, I don't anticipate it to be substantial, depending on them. I would expect them to do a toll treatment agreement with us. And we can decide to participate or not. If we don't, we dilute. If we do, we keep our position.
If the two parties can't agree on an operational JV agreement, is there a possible way that they can continue mining separately?
So I think this is a question around the original. So originally when we invested in this, we invested on an exploration earning agreement. Now that that's complete, we operate under the articles of the joint venture, in which we basically contribute, as I've mentioned, our choice on to the funding of the asset. As I said, we don't anticipate there to be a massive capital expenditure or a new plant to be built, because that would be already built for the first asset, for the first mining schedule. What will happen at that point is, and this is what typically happens, is that after, as we get to mining, or even before that, there would be a toll treatment agreement in which they or their mining contractors would mine the area at a cost. They would then treat the material at a cost, which would then produce a product which would be then, the profitability would be then delivered to the JV company and then delivered as per the shareholding agreement. There may be some small capex, but I don't envisage that to be the case. If they decide to, ultimately, whether we participate or not is whether we contribute or not. And I think we'll be able to reach an agreement, just because otherwise it doesn't really make sense for them otherwise to develop it.
That's great. And a final question from one more investor is, they ask if you could give some idea of the values of Sonora and how the value will be realized exactly.
Yeah, so they're both they've asked here for also as well the value of Yangibana. Look, I've asked this many times. We have our internal value of our assets. We revise these regularly. However, we're not going to disclose those NPV valuations for several reasons. By disclosing these values, we provide any joint venture partner, commercial partner, buyer of the asset information in terms of valuation that can jeopardize our negotiating position. So I'm not going to disclose it, because by doing so, that jeopardizes our negotiating position, or could jeopardize our negotiation, and therefore destroy or not deliver enough value or the potential value to our shareholders. And in addition, valuations change depending on mining schedules, process, as we've seen with the asset at Yangibana and Sonora. The mining schedule changed and the valuation changed as a result of that. Processing costs change, processing techniques, OPEX. However, the market seems to only remember the highest valuation that I quote, without taking into account these changes. So, the valuations, we have them, so we assess them, but we're not really going to disclose these internal valuations for the two reasons that we've mentioned above.
Great. Thank you so much, Kiran. We've answered a lot of questions here, and thank you for your presentation.
Thank you very much. It's been a pleasure.